Australia's economic recovery continued over the September quarter. The September quarter national accounts showed the economy grew 2.1% in year-ended terms. And while the September quarter outcome was softer than we at Westpac Economics and the market were expecting, the growth of 0.4% over the quarter, coupled with upward revisions to activity in previous quarters, showed the recovery remained on track. Domestic demand was a standout, and it wasn't only consumers. Businesses also ramped up investment, housing construction continued to expand, and there was no need for a handover. Both public and private demand continued to grow. Growing at 1.2% over the September quarter, we have to go back to late in the mining investment boom to find comparable growth rates for domestic demand. Business investment made an outsized contribution to growth in demand, growing 3.4% on the back of investment in equipment for data centers and civil planes as well. Despite this, construction outside of housing remained soft, growing just 0.5% over the quarter. This suggests that the pickup was not as broad-based as we had previously expected. Business investment as a share of the economy remains low. For this to pick up, we need to see construction outside of housing also grow to complement investment in machinery and equipment. The pipeline of possible energy projects and the shift in the drivers of growth to the market sector, which is more capital intensive, should help in this regard, but risks remain. After the bumper June quarter, consumers did not put away their wallets, with consumer spending picking up a further 0.5% over the quarter. The consumer outlook is firmer now on the back of higher incomes. But here too, there are risks, with the national accounts showing that bracket creep has started to chew away at disposable incomes. Demand was really strong over the quarter, but supply is also stepping up. Productivity growth lifted over the quarter, which means we were able to produce more with the amount of resources we have. This will help the economy accommodate stronger demand going forward. We saw productivity increase 0.8% in year-ended terms, while in the market sector, excluding mining, we saw an increase of 1.4% in annual terms, which is much stronger than recent outcomes. Now, as productivity continues to normalise and resumes to grow, this will see growth in the economy's cost base moderate, which will help keep inflationary pressures contained even when there is growing demand. So this may see inflationary pressures become more benign than widely feared. So what does all this mean? The economic recovery remains on track, with domestic demand responding to last year's tax cuts, this year's rate cuts, and lower inflation. And even more positively, the upswing is likely to gain greater momentum the longer it runs. This is not a bad thing, particularly if there's supply capacity to meet this greater demand. And on this front, the national account suggests supply capacity is indeed expanding to meet demand.